Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us. Please don't forget to like and subscribe. Click the bell so you get a notification of when we release a new video. I'm sitting today with Nick Rogers. Welcome, Nick.
Hi, Robin.
Nick is one of our portfolio managers. He's also responsible for the Harvard House BCI Equity Fund. And Nick, one of the things that the tenets of the Harvard House investment philosophy is really investing in growth assets, but particularly focusing on a growing income. Now, that's people who are not investing for income obviously don't always understand this concept, but a growing income stream ultimately leads to a growing market value. Can you talk about the fund and how things have progressed from an income point of view, and are we still on track and managing to our philosophy?
Robin, yes. So we'll start with the inception of the fund, which was in 2006. You can see on the chart, the dark blue column is inflation, and we paid a dividend in 2007 of 2.33 cents a unit. Now, if you look right across to the last year, we paid inflation's averaged 5.4%. The fund has actually grown the dividend at 8.7%, so comfortably outperforming inflation by over 3%. And it's really important in these times. Everyone is feeling the pinch. Everyone's much more aware today of what inflation really does to your purchasing power of money. So to have it invested in a bank, you're not going to outperform inflation. And 16 years down the line, you can see the difference. So this growing earnings above inflation and the dividend above inflation is really important to keep the value of money present.
So in terms of, our argument is always to grow the dividends, and the market value will ultimately catch up with that. The market value in this fund obviously has fallen a little bit behind in terms of how the dividend has grown, but the story is still intact in terms of growing dividends, and that's something that you're looking to do on an ongoing basis in the management of this fund. Is that correct? Correct,
Robin. Again, in 2007, when we launched the fund and paid the first divvy, you had the global financial crisis just around the corner. Now, no one knew that was coming. It hit really hard. The divvy obviously comes off because companies are protecting their balance sheets and keeping themselves cash flush during tough times. So the dividend comes down when there's a crisis. And you can see that again when COVID hit 2 years ago. Every decade we'll have a number of crises. We've had Brexit, we've had COVID now, we've obviously had the war in Ukraine. The dividend takes a knock then, but you'll see it's bounced back this year very nicely, as it did in 2009. And we're looking to pay out higher than 2019 levels, which just goes to show you've got to stay invested. And it's core to our philosophy is stay invested in the market. Don't worry about what the capital is doing, because in the background, the dividend is building the foundation for the future.
That's amazing. And in fact, if you look at that chart, I think what you can see is that if you'd been invested right from the start, your growth in the dividend ahead of inflation even kept you ahead of the drop of the dividend was still well ahead of inflation in the midst of COVID, which is probably the worst event in 100 years. Nick, thanks so much for joining us and giving us a little bit of insight into the fund. Thank you for joining us. Don't forget to subscribe and join us again next time. Thank you.